G'day everyone, it's Greg Canavan with Ryan Dents with you. We've got another Q&A session. Good to see you're all sending loads of questions in for us. So Ryan, we'll get stuck straight into it. First question comes from Tom. And I think this is probably, a question that a lot of people have. It's that very early stage trying to set up their Bitcoin or crypto situation. So he says, I'm interested in setting up a BCA. I'm not sure what a BCA is actually, to make daily and hourly purchases. Where do I set this up? Do I do it through my NabTrade account? I cannot see anything in there about Bitcoin. Where do I buy the wallet as well? And do I need all the rigmarole of posing with my passport and other ID photos?
I think he meant DCA, so dollar cost average.
That's the one.
That's the one, yeah. So yeah, a good idea. Like we recommended in the monthly to dollar cost average, especially when you're new and you want to buy some Bitcoin rather than try to pick a point in time where you think it's cheap. You just put some in. I wouldn't do it hourly or daily though, to be honest. I would probably do it monthly, something like that. Build up enough to do it once a month over, say, 6 months or whatever your time scale is to put in the amount that you decided you want to put at risk. And remember, it is still the risky side of your portfolio. So as we talked about, this is a new financial ecosystem and you can't use the old products. Like as of today, NabTrade won't allow you to buy Bitcoin, eTrade won't, Bell Direct won't. Even the CFD providers that say they allow Bitcoin exposure are usually CFDs. They're not actually buying Bitcoin. So eToro is a big one. You're never actually buying any Bitcoin. You're just buying into the price of Bitcoin. To actually buy Bitcoin, you need to use a proper Bitcoin exchange or proper cryptocurrency exchange. The one we recommended, I think in the monthly for dollar cost averaging, the Australian one we recommended is one called Bitaroo, and it is in the monthly. And they allow you to set up an automatic dollar cost averaging system. So you can set it and forget it. What you will have to do though is, from time to time, move your Bitcoin into a wallet you control. Again, this is the thing that's different about this new financial system. You don't want to rely on other people holding your Bitcoin for you, because the risk there is that if an exchange gets hacked or something like that, you can lose your Bitcoin. And that has happened numerous times in my 8 years in crypto. So I'm very conscious of that risk, and it's a risk you can ignore until it happens. But when it happens, it's too late. So you don't need to be too panicky about it. But if you are dollar cost averaging through an exchange like Bitaroo, every now and again, move some of that Bitcoin into another wallet that you hold the private keys to. And we do have a report that I think we've had some problems with production, put it on the site, but it should be on the subscriber site very shortly. And it's called your Crypto Trade Station Setup. And that'll provide you with some options of Bitcoin wallets you can use, which are ones that you control, which is a very important mindset to get into with crypto. The whole concept of crypto is about not having to trust anyone else. And that means some element of self-responsibility, and it involves some element of work and thinking, especially as it's new, and there's no getting away from that. But that, in my head, is the price of self-sovereignty, which is the whole concept behind this new world.
Yeah, I think that's the important point from this question, is that different system, different setup. We're using different financial infrastructure and different architecture to make these investments. So what you think you can all do on whether you use ComSec or NabTrade or whatever, the land of cryptos is in a completely different system, which requires different setup steps and all those sorts of things. So it's just a learning phase, and the more that you sort of get your head around that, the easier it becomes to deal with.
Yeah, like any setup thing, you only have to do it once. You know what I mean? For one exchange or one wallet. You pose with your passport on your webcam for proper regulated Bitcoin exchanges, which is fine. But I mean, I don't know when was the last time someone tried to deal with a bank and you had to make an appointment in branch, and it can take weeks. I think it takes on average 2 weeks to open a bank account through a bank. So, posing with your passport for a webcam, which might take a day, is a vast improvement than what you'd have to do in the legacy banking system anyway. So.
Yep, absolutely. Okay, next question from Peter. This is we could probably go into quite a bit of detail here, but it's a really good question. So we'll take it nice and slow. It says, can you explain what happens to the value of your stable coins pegged to the US dollars when the value of crypto drops or increases? I assume when you buy stable coins to use as lending capital, you get a certain amount of stable coins for each crypto coin, depending on the value of the crypto. If the value of crypto increases, do you miss out on this crypto gain with your stable coins when you convert them back to crypto? And conversely, do you make a gain with your stable coins when crypto values fall? If these scenarios are true, then converting crypto to stable coins to gain an income of interest would seem to have added risks with market fluctuations. So there's a bit to unpack there. What's the, where do you want to start?
I'll try and start with the simplest part, which is a stable coin is a cryptocurrency that tries to maintain a one-to-one peg with the US dollar. And the mechanics of that are different for each type of stable coin, but a lot of the most popular ones manage to keep the value of their stable coin very close to a US dollar. So maybe from 99 cents to $1.01. Now, it is possible to buy stable coins without ever having to worry about the mechanics of how they're created. So if you're doing that, which is probably a strategy we'll get to in the next couple of weeks, you don't need to worry about how they're created so much in terms of your investment, in terms of capital fluctuation. If you're just buying the stable coin itself and investing that in a certain way to generate an income.
And what you're referring to there is just going straight from fiat currency into a stable coin.
Yeah, correct. Yeah, maybe through a pathway of having to buy a crypto to buy them, but essentially, yeah, you just convert your dollars into a stable coin. Now, if you're doing that, you don't need to necessarily worry too much about the back end of how it's created. And that's where maybe the confusions come in, because some stable coins, I think as the reader alluded to, some stable coins, how to create them involves locking up a cryptocurrency like Ethereum or Bitcoin and then using that as collateral to create a cryptocurrency. And the most common one's called DAI, which is DAI. And if you're doing that, then of course, if the value of your Bitcoin or Ethereum that's locked up fluctuates, then of course you're going to have some capital growth or appreciation or depreciation, depending on the way that goes. And so if you were creating that DAI, if you were the person, acting as your own central bank essentially and locking up some assets and creating dollars out of that, of course you'd have some fluctuation in the value of Bitcoin and Ethereum behind it. And that's a different aspect though from the other side of things, where you just buy the stable coins themselves and you're using them to try and generate an income. That's sort of two separate things you can do. It sounds a little bit confusing. Hopefully I've explained that well enough.
So in that situation where you are using, let's say, Bitcoin or Ethereum as collateral to buy or to create these stable coins, let's say Bitcoin was 60,000 when you first did it, and then you've created essentially 60,000 worth of stable coins. Now Bitcoin falls to 40,000. Yeah, but you've still got essentially a face value of 60,000 worth of stable coins.
So to use those examples, first of all, if you were locking up $60,000 worth of Bitcoin, you couldn't create $60,000 worth of DAI because the system requires you to be over collateralized. So in that example, probably the most you could create out of that would be maybe $40,000 worth of stablecoin for $60,000 worth of collateral. So there's a buffer there, and that's the absolute maximum. If it was me doing it myself, I would probably only create $20,000 with $60,000 worth of collateral, because the risk, as you say, is that 60,000 turns into 30,000, and suddenly I'm at risk of having to sell some of my Bitcoin to make sure my ratio of dollar coins to my collateral stays within the accepted parameters, which can vary depending on what you're using as security. So if you are taking that stance, let's say a strategy some people use, for example, is they might lock up their Bitcoin, create some DAI, and use that to buy another cryptocurrency. So they're like leverage trading. Some people, that's how they do it. And so the risk they take there is that the value of the crypto falls. And in that case, they would then have to sell some of their Bitcoin to make sure they stayed under the collateral ratio.
Yeah, well, I guess that's the follow-up question is that, let's say, you talked about your margins and how much you can actually create or borrow based on a certain amount of Bitcoin. So in that first example I gave, just thinking about it logically, you create a certain amount of stable coins, but then your collateral falls. Where is your Where is your wealth tied to? Is it tied to the stable coins, or will there be a call on those stable coins to pay them back to put you back in a line?
So your wealth is tied to both. Like the value, if the value of your collateral goes down, then your wealth falls. The value of your stable coins will stay at 1-to-1, but there's a point where if your collateral falls enough, then you have to pay some of those stable coins back. So,
gotcha.
But the key there is that you have to do that so that if you think about the system as a whole, that has to happen because that helps make sure that that stable coin, which is DAI, for example, maintains its peg. It only maintains its peg because people have confidence that not just me, but everyone in this ecosystem
the systems,
is over collateralizing. So even though I might face a margin call, that just means that I need to sell some of my collateral to pay off some of that DAI that I've created. That might not be a big effect on the system. And the sort of proof of that was the recent huge falls that we had in Bitcoin and Ethereum recently. 50% fall was very sharply. DAI, the stable coin, maintained its 1-to-1 peg throughout that system. Individual traders might have got liquidated. Some people might have had to sell some to pay back some of the DAI they'd borrowed and unwind some of that position. But the stable coin itself, if all you had was a stable coin and you weren't the one that created it, you just bought that stable coin to do something with, you didn't actually need to worry about all of that because for your purposes, that maintained its 1-to-1 peg.
Yep.
The other point I want to make is that we're probably talking about the most complex stable coin there is right now, which is DAI, which is probably the most interesting as well. But there are other stable coins as well. There's not just one, there's several. Something like USDC, which is created by a regulated US entity called Circle, which is quite attracted a lot of investor capital. They create their stable coin simply by putting US dollars in a regulated bank account.
Yep.
So that stable coin, for example, is backed 100% by US dollars in a bank account in America, regulated, audited, all that stuff. So that stable coin, again, the mechanics of how it's created are different from DAI. But again, if you just bought that US dollar stable coin, you don't really need to worry about that as long as the peg is staying pretty close to $1. So
and as long as those protocols are adhered to, the peg should remain. I guess the answer to the question is that you are still exposed to the fluctuations of if you are using these stable coins or creating stable coins based on the collateral of an Ethereum or a Bitcoin, you're exposed to the fluctuations in the underlying Bitcoin or Ethereum as well, because you might be called on to pay down or repay some of those stable coins. Say your margin requirements stay within a certain limit, right?
So if you are creating that DAI stablecoin, which is the completely decentralized way to create a synthetic dollar, which is awesome. But if you are doing that, then of course, your collateral, you need to watch that depending on how much DAI you've created from that and manage that. And in the case where you buy stable coins purely from fiat, then that's not as big an issue, right? Because you don't have any sort of underlying collateral there. Correct. It's not as big an issue, but the value of say one USDC or one DAI or one Tether, it can fluctuate. Like you've got to think of it as the market's deciding what that stable coin is worth, and a lot of the time the market keeps it pretty close to the dollar because the market trusts the systems that underpin that. But for example, a few years ago, the system for creating DAI was a lot less immature, and I think there was times when the value of one DAI fell to like 96 or 95 cents, or even a lot less, like very temporarily, before the market saw that the system was working and pushed it back up to the dollar. So there are professional firms and normal crypto investors that purely trade the arbitrage around dollars. If you're doing a lot of big money, you can make a lot of money when something goes to $1.02 as opposed to $1, because it's going to revert to the mean. And so there's a whole ecosystem of stable coins which has grown massively in the last 12 to 24 months. And I think in the report that we're going to release, I think one of the reports that we did release explains a little bit about those mechanics more, one of the welcome reports. And when we get to the stage of explaining how to generate income from stablecoins, we'll explain some of that as well.
Yeah, absolutely. I hope you enjoyed that preview from New Money Investor. To get access to the full video and much more, please click on the link below.